You've heard people say invest in index funds over and over again. Every finance video, every money guru, every Reddit post. Index funds, index funds, index funds. But nobody actually explains what they are. Like actually explains it in a way that makes sense. So you nod along pretending you get it. Or you skip it entirely because it sounds complicated. Here's the truth. Index funds are stupidly simple. And by the end of this video, you'll understand them better than 90% of people. No jargon. No confusing charts. Just plain English. Let's break this down. First, let me tell you what an index fund actually is with a real-world example. Imagine you want to invest in tech companies. You're thinking Apple looks good. Maybe Microsoft. Google seems solid. Amazon's huge. Tesla's interesting. So you decide to buy all 5 stocks. Apple, Microsoft, Google, Amazon, Tesla. But here's the problem. You need to research each company. Figure out if the stock price is fair. Decide how much to put in each one. Monitor all 5 stocks. Sell the losers. Buy more winners. It's a full-time job. And what if you pick wrong? What if Tesla crashes and wipes out your gains from the others? Now imagine a different approach. Instead of buying 5 individual stocks, you buy one thing that automatically owns all 5. Plus every other tech company. Big ones. Small ones. All of them. That's basically what an index fund does. An index fund is a basket of stocks bundled together. You buy one fund. You own hundreds or thousands of companies at once. You don't pick winners. You own everything. When the overall market goes up, you go up. Simple. Let me give you a concrete example everyone knows. The S&P 500. You've heard this term. It's an index that tracks the 500 largest companies in America. Apple, Microsoft, Google, Amazon, Tesla, Nvidia, JP Morgan, Visa, Johnson & Johnson, 491 other massive companies. When someone says the market is up today, they usually mean the S&P 500 is up. Now here's where index funds come in. An S&P 500 index fund is a fund that buys all 500 of those companies automatically. It mirrors the index exactly. You buy one fund. You instantly own pieces of 500 companies. The biggest companies get the biggest portions. Apple is about 7% of the fund because it's one of the biggest companies. A smaller company in the S&P 500 might be 0.01%. The fund automatically rebalances. If a company gets bigger, it becomes a bigger part of your fund. If a company gets smaller or drops out of the top 500, the fund adjusts. You do nothing. You buy it. You hold it. It handles everything else. This is why people keep saying invest in index funds. It's the easiest way to invest in the entire stock market without picking individual stocks. Now let me show you why index funds beat everything else. And I mean everything. Pause. There's this study that gets brought up constantly. Warren Buffett made $1 million bet in 2008. He bet that over 10 years, an S&P 500 index fund would beat professional hedge fund managers. These are the smartest money people on Wall Street. PhD mathematicians. Billion-dollar funds. Teams of analysts. The best of the best. Buffett won. And it wasn't close. The index fund returned 7.1% annually. The hedge funds averaged 2.2%. The richest investor on the planet bet that a simple index fund would beat the experts. And it did. Here's why this happens. Hedge funds charge high fees. 2% management fee. 20% of profits. Those fees eat your returns. Index funds charge almost nothing. Some charge 0.03%. That's 3 cents for every $100 invested. Per year. The hedge funds have to beat the market by enough to cover their fees and make you more money than the index. They almost never do. Over 15 years, 92% of professional fund managers failed to beat the S&P 500 index. 92%. These are professionals with decades of experience. They can't beat a simple fund that just buys everything. So why would you try to pick stocks yourself? You wouldn't. You'd just buy the index fund and chill. Alright, let me address the questions I know you're thinking right now. Question 1. Which index fund should I buy? There are thousands of index funds. But you only need to know about a few. S&P 500 index funds. These track the 500 largest U.S. companies. Most popular option. Examples are VU from Vanguard, SPY from State Street, or FXAIX from Fidelity. Total U.S. market index funds. These own the entire U.S. stock market. Not just 500 companies. More like 3,000 to 4,000. You get big companies plus smaller ones. Examples are VTI from Vanguard or FSKAX from Fidelity. Total World Index Funds. These own companies from around the entire world. US, Europe, Asia, emerging markets. Maximum diversification. Examples are VT from Vanguard or FZROX from Fidelity. For most beginners, I recommend starting with either an S&P 500 fund or a total US market fund. Both are solid choices. You really can't go wrong. If you watched video 2 in this series, I recommended FZROX from Fidelity. That's a total US market fund with 0 fees. Great starting point. Question 2. How do I actually buy an index fund? Super simple. Step 1. Open a brokerage account. Fidelity, Vanguard, or Charles Schwab. Takes 15 minutes online. Step 2. Transfer money from your bank to the brokerage account. Step 3. Search for the fund you want. Type in VU or VTI or whatever. Step 4. Click Buy. Enter how much money you want to invest. Step 5. Confirm. Done. You now own an index fund. Congrats, you're an investor. If you want the detailed walkthrough, go watch video 2 in this series. I break down every single step with exact screenshots. Link in description. Question 3. How much money do I need to start? Less than you think. Most index funds let you start with any amount. $10, $50, $100. It doesn't matter. Some funds have minimums. Vanguard's funds often require $3,000 minimum for the mutual fund version. But you can buy the ETF version with any amount. ETF stands for Exchange Traded Fund. Same thing as a mutual fund index fund, just trades differently. You can buy partial shares at most brokerages now. Bottom line. You can start with whatever you have. Don't let small amounts stop you. Question 4. When should I invest? Should I wait for the market to drop? No, don't try to time the market. Studies show that people who invest consistently at the same time every month beat people who try to wait for dips. Because nobody can predict when dips happen. You think you'll buy when it crashes. But then it crashes and you think it'll crash more. So you wait. Then it recovers and you missed it. Just invest consistently. Same amount. Same time. Every single month. This is called dollar cost averaging. Some months you buy when prices are high. Some months you buy when prices are low. Over time, it averages out. And you don't stress about timing. Set up automatic investments. Forget about it. Let it compound. Before we keep going, quick favor. If this explanation is actually making sense to you, hit that like button. It helps the algorithm push this video to more beginners who need it. And if you haven't subscribed yet, subscribe now. This is video 5 in a complete wealth building series. We've covered money lies, your first $1,000, retirement numbers, income streams, and now index funds. Next video I'm breaking down exactly how much to invest per month at every age. You need to see that. Hit subscribe. Alright, let's tackle more questions because I know you got them. Question 5. What returns can I expect from index funds? Historically, the S&P 500 has returned about 10% per year on average over the last 100 years. Some years it's up 30%. Some years it's down 20%. But average it all out over decades and it's around 10%. 10% doesn't sound like much. But let me show you what it does over time. You invest $500 per month for 30 years at 10% average return. After 10 years you have about $102,000. After 20 years you have about $379,000. After 30 years you have over $1 million. $1,013,000 to be exact. $500 a month for 30 years turns into $1 million. That's the power of compound interest in index funds. And you don't have to do anything except keep investing consistently. No stock picking. No timing. No stress. Question 6. What if the market crashes right after I invest? It might. Crashes happen. 2008 crashed almost 50%. COVID crash in 2020 dropped over 30% in weeks. But here's the thing. Every crash in history has recovered. Every single one. The S&P 500 crashed 50% in 2008. By 2013 it was back to where it started. By 2020 it had tripled. If you invested at the absolute peak before the 2008 crash and just held, you'd be way up today. The key is you don't sell during crashes. You hold. You keep investing. You buy more shares at lower prices. Crashes are sales. Everything's on discount. That's when you want to buy more, not sell. But here's the real secret. You won't time the crash anyway. Everyone thinks they'll buy at the bottom. But when the market drops 30%, all the headlines say it's going to drop 50%. So you wait. Then it recovers and you missed it. Nobody consistently times the market. Not professionals. Not gurus. Not you. So don't try. Just invest consistently and hold for decades. Question 7. Are index funds safe? No investment is completely safe. The market can drop and stay down for years. But here's the data. Over any 30-year period in the S&P 500's history, investors have always made money. Always. Not sometimes. Always. There's never been a 30-year period where you lost money in the S&P 500. Even if you invested right before the Great Depression. So if you have 30 years, you're basically guaranteed to make money historically. If you only have 5 years, it's riskier. The market might be down when you need the money. Rule of thumb. Only invest money you won't need for at least 10 years. Better yet, 20 or 30 years. Money you need in 2 years? Keep it in a high-yield savings account. Money you need in 20 years? Index funds. Question 8. What about fees? Fees matter a lot over time. Let's say you invest $100,000 for 30 years. Fund A charges 1% fee per year. After 30 years you have $574,000. Fund B charges 0.03% fee per year. After 30 years you have $838,000. Same investment. Same returns. But the high-fee fund costs you $264,000. That's why index funds are so powerful. The fees are near zero. Vanguard's VU charges 0.03%. Fidelity's FZROX charges literally 0%. Always check the expense ratio before buying any fund. If it's over 0.5%, look for something cheaper. Question 9. Should I invest in individual stocks too? You can. But you probably shouldn't. Remember that stat? 92% of professionals can't beat the index over 15 years. You're not going to beat them. Some people like to keep 90% in index funds and 10% in individual stocks they believe in. That's called a core and satellite approach. Fine if you want to scratch the stock picking itch. But honestly, you'll probably do better just putting everything in index funds and forgetting about it. Boring? Yes. Effective? Extremely. Question 10. Index funds or ETFs? Both are basically the same thing. Both track indexes. Both have low fees. Difference is how they trade. Mutual fund index funds trade once per day at the end of day price. ETFs trade throughout the day like stocks. For long-term investing it doesn't really matter. Pick whichever your brokerage offers with the lowest fee. If you're at Fidelity, their mutual fund versions have 0 fees. If you're at Vanguard, their ETFs are super cheap. Don't overthink it. Just pick one and start. Alright, let's bring this all together with the simple action plan. Step 1. Open a brokerage account if you don't have one. Fidelity, Vanguard, or Schwab. Step 2. Choose an index fund. Start with S&P 500 fund or total US market fund. VU, VTI, FXAIX, FZROX. Any of these work. Step 3. Set up automatic monthly investments. Whatever amount you can afford. $100, $300, $500. Consistency matters more than amount. Step 4. Hold for decades. Don't sell when it crashes. Don't check it every day. Just let it compound. Step 5. Increase your contributions over time. Get a raise? Increase your investment. Side hustle paying off? Invest more. This accelerates everything. That's it. That's the whole strategy. You're not picking stocks. You're not timing markets. You're not paying high fees. You're buying the entire market, holding for decades, and letting compound interest do the work. This is how regular people become millionaires. Not by getting lucky with a hot stock. By consistently investing in index funds for 30 years. If this video finally made index funds click for you, smash that like button. It helps more than you know. Drop a comment telling me which index fund you're going to start with. VU? VTI? FZROX? Something else? Let me know. I read every comment. And subscribe if you haven't. Next video I'm breaking down exactly how much to invest per month at every age. 25, 30, 40, 50. I'll show you the exact numbers to hit your goals. You need that video. Subscribe so you don't miss it. Thanks for watching. Now go open that brokerage account and buy your first index fund. See you in the next one.